Shares of SpaceX became available to the public for the first time 2 weeks ago via the largest initial public offering in history. In this video, I will explain a 12-month investment strategy that provides the ability to either buy shares at the IPO price, that's the initial public offering price, or receive a rate of return of 22.7%. My name is Ron Didesco, and I am a CFA charter holder, which stands for Chartered Financial Analyst. I am a hedged income investment advisor with bespoke TFC Capital. Let's begin. Shares of SpaceX were priced for its IPO at $135 a share. Once the stock began trading publicly, it opened at approximately $150 and over the next few days rose precipitously to peak at $225 per share. Since then, the stock has rolled over and fallen from $225 down to its current level of approximately $153 per share. With shares of SpaceX currently trading at approximately $154 a share, this strategy provides either the requirement to buy 100 shares of stock at $135 a share over the next year, or earn a rate of return equal to 22.7% if shares of the stock do not fall below $135 over the next 12 months. The name of the strategy is called selling a cash secured put. This is a strategy that we implement on behalf of clients when appropriate. Here's how the strategy functions. At the time of implementation, with stock trading at $154 a share, you do not own any shares. Instead, you go into the options market, in this case expiring 12 months into the future, and you sell one put option at a strike price of $135 a share. $135 a share is the IPO price. What does this mean? Well, selling a put option means that you are entering into a contractual obligation where you will be forced to buy shares of the stock will be put to you, if shares of the stock are trading anywhere below the strike price, which in this case is $135 a share, by option expiration, which in this case is 12 months into the future. So with stock trading at $154 a share, if the stock falls below $135 a share, over the next 12 months, the stock will be put to you, you will be forced to buy at $135 a share, irrespective of how much lower the stock may be trading at that time. Why would you enter into such an obligation? Because in exchange for doing so, you receive income called hedged income of $28 a share. Let's take a look at another screen to understand the math better, and keep in mind too that one put option is equal to 100 shares, so some portfolio scale is required for the strategy to be implemented. The first step of the strategy is to not buy the stock at its current price of $154 a share. The next step is to sell that put option, expiring 12 months into the future, at a strike price of $135 a share. In exchange for doing so, you receive hedged income of $28 a share. You need to hold cash in your brokerage account equal to the potential share purchase, which is that strike price of $135 a share. So the cash held for the potential share purchase is $135. That's your investment basis. The income received, the hedged income of $28 a share. $28 of hedged income divided by your investment basis of cash, collateral cash of $135, equals hedged income of 20.7%. Additionally, the cash held generates interest, which is expected to be 2% over the next year. The total return potential is the sum of the hedged income, 20.7%, plus that interest on cash of 2% for 22.7%. This is your profit if the stock does not fall below the strike price of $135 a share by option expiration. So the total potential return is 22.7%, or $30.70 against an investment basis of cash held for $135 a share. In the event that the stock falls, the downside break-even price is $104.30. This is 32.3% less than where the stock currently trades. How do we arrive at this number? Well, this is simply the cash held of $135 a share, less the hedged income received of $28 a share, less the interest from the cash of $2.70. So in this strategy, the stock has to fall more than 32.3% over 12 months in order for loss exposure to be realized. The degree in which the stock can decline and the hedged return is still maximized is minus 12.3%. That's the difference between where the stock currently trades, $154 a share, and the strike price of $135 a share. So what this means is if come option expiration in 12 months, shares of the stock are anywhere above $135 a share, so that's $136, $154, $200, whatever the case may be, the maximum profit is $30.70 against your investment basis of the cash held of $135 for that return of 22.7%. So upside is capped at 22.7%. You have downside protection up to minus 32.3%, and the stock can fall as much as 12.3% with this profit still being maximized. This is what the payoff profile looks like for the strategy over the 12-month hedged investment horizon. So the hedged income generated is 20.7%. The interest income on the cash held is 2%. The sum of these two numbers, the 20.7% plus the 2%, equals total return potential of 22.7%. Irrespective of how much higher the stock trades come option expiration in 12 months, the maximum return for the strategy or its limitation is 22.7%. In the event that the stock can fall as much as that 12.3%, and this total return potential of 22.7% is realized. If the stock falls further below 12.3%, then there's additional buffer to the downside. There's still profit realized, but to a diminishing degree, and there's protection all the way down to 32.3%. The stock has to fall more than 32.3% over 12 months in order for the strategy to lose money, while its upside potential is capped at 22.7% and also realized if the stock rises to any degree, is unchanged, or falls as much as 12.3% over 12 months. Let's take a look at scenario analysis for what might occur come option expiration in 12 months. In the event that the stock is unchanged, so the share price is $154, the stock return would be 0% over the next year, though the hedged return would be positive 22.7%. As the stock rises, the stock return increases to an uncapped amount, while the hedged return is capped at 22.7%. So if the stock rises 20.1% to $185, the hedged return actually outperforms at 22.7%. If the stock rises to $215, which is an increase of 39.6%, then the hedged income underperforms at 22.7%. Now, we're not adjusting for risk because this strategy provides enhanced downside protection and the risk-adjusted returns are significantly greater. So the question becomes, how much value is there to you knowing that you have significant downside protection with your investment structures? In the event that the stock falls, say 9.1% to $140, well, the strategy still delivers a return of 22.7%. If the stock falls 28.6% to $110, the strategy still delivers a profit hedged, and that hedged return is 4.2%. If the stock falls further, say down 38.3% to $95, then the hedged return is minus 6.9%. So what you can see here is this strategy provides significant downside protection, outperforms when the stock is unchanged or falls to any degree, though the limitation is that if the stock rises significantly, the upside potential for the strategy is capped at 22.7%. Before we wrap up, if you're enjoying this video, then leaving a like and a comment would help us significantly. If you'd like to learn more about our Hedged Income Investment Advisor service, then go to our website at bespoketfc.com, and in the top right-hand corner, click Insights if you would like to see portfolio examples between $300,000 and $6 million for different hedged income investment strategies. Concluding today's video, let's just comment on some portfolio investment notes. So, this video does not constitute investment advice. I do not understand your circumstances or what your objectives are, and this strategy may be optimal or it may be very different from what you're trying to achieve or what might even be appropriate for you. Also, keep in mind that all of our client portfolios are customized with diversification in portfolio weights and strategies that are tailored for each client. For instance, in today's video, we talked about this hedged income investment structure for shares of SpaceX. This strategy is focused on that downside protection with a defined total return potential to the upside. The inherent benefit to this strategy is that if the stock rises modestly, is unchanged, or falls, then this hedged income strategy outperforms that of a stock-only strategy. However, if you would actually like to own shares of SpaceX for the long term, measured in years or even decades, then a strategy like this may provide you with the missed opportunity for outsized significant gains if the stock rises significantly. And whereas you were protecting more for the downside, you missed the upside if the stock moves appreciably higher, and this strategy would not have achieved your ultimate goal. So once again, keep in mind that this video does not constitute investment advice. Thank you for watching, like and subscribe, and hopefully you'll watch more videos in the future.